Hello, I'm Lilda Smits for the Finance News Network, and joining me today is the author of Debunking Economics, Dr. Steve Keen. Steve, welcome back to FNN.
Delighted to be here.
Now, Steve, you have quite the reputation for your doomsday predictions, but here in the lucky country, Australians are feeling pretty good right now. The S&P ASX 200 is at 5-year highs and interest rates are at record lows. What is there to worry about?
Well, in Australia, even though we've had those two features, we've also had rising unemployment. The trend has been up from 5% heading towards 6%. So happiness is largely isolated to the asset markets here. It's not so happy out where you've got to get a job. And this is the long, slow grind that was the alternative, what could have happened, which would have been the deep plunge that occurred first of all in America and then certainly in Europe. So we're happier than the rest of the world, but the world is not a happy place.
So you're saying it's not as good as it looks?
We are now in a long-running global financial crisis, which I called back in 2005, not just for Australia, but for the entire planet. But, or the entire OECD. But Australia is the one country that dived in very rapidly with, first of all, sensible, rapid anti-recessionary policies, but then also restarting its property bubble.
Moving to interest rates, Australia's key cash rate was cut to a record low of 2.5% this year, increasing borrowing capacity. But where do you see interest rates headed next year, and how will this impact property?
I think they'll start raising rates.
When?
Probably, I'd say probably around March to June. I think it most likely to start putting rates up to try to control the bubble, because the bubble will actually stimulate the economy a bit. Borrowed money spent into the economy will cause unemployment to fall a bit. They'll think it's recovery time, the usual pattern, rising house prices, falling unemployment, start putting rates up, and the whole thing will start to fall over.
The property sector is, of course, intrinsically linked to the lenders of debt, which you've blasted in the past for their irresponsible lending practices. But when and how does lending become dangerous?
When you start having lending driving up asset prices and therefore causing people to borrow more money at higher and higher levels of leverage. And we've allowed ourselves back in this situation again.
And do you think the risk has stabilised, or is it increasing?
It's increasing. If it happens now, they start competing for market share.
Turning to the US now, Steve, quantitative easing may soon be coming to an end, with stronger than expected US data fueling speculation. The US Federal Reserve may start to taper its economic stimulus soon. How long do you think the US central bank will continue to spike the punch?
Well, I think for starters, it's actually spiking the punch with a placebo. Okay? It's not actually real alcohol, because if you actually wanted to print money, as people paraphrase what they think QE is, that'd mean putting money into people's bank accounts directly, which QE doesn't do. So it's spiking the wrong side of the punch, if you like. It's a placebo, but it does drive down yields in long-term bonds, so it encourages people to speculate in shares and property instead. That's why the asset markets have taken off so much.
And when do you see it coming to an end?
I'd say it'll come to an end next year, it'll start the year after, come to an end the year after that, start the year after again. This is what the Japanese have been doing for 2 decades.
And what repercussion could we see on our markets then?
Volatility up and down. Whenever they stop it, then the markets will come down. But the result will be similar to Japan, maybe not the same scale of fall in asset prices there, because share prices fell 80% in Japan and house prices have fallen about 70%. But simply doing the wrong thing, and when it doesn't work, doing it more often and harder.
You mentioned Japan a lot as far as a comparison. Why do you think the nation is the best comparison for global nations such as the US and Australia?
Really because it gave us 25 years warning of what we shouldn't do, and we did it anyway. If you look at what happened in Japan, they had a gigantic property bubble and a gigantic share market bubble.
Finally, Steve, in 2009, you told FNN we're going into a depression and you're putting your money into cash. Now, are there any sound investments out there at the moment, or should we still be putting our money under the mattress?
Well, the sound investments are ones that preserve the capital you gained during the bubble. That's the most important thing. So the trouble is, when you have a bubble and it bursts, then people then say, how can I get the same returns as before during the bubble? You'll say, not reliably. Okay? If you wanted to get those gains, you may be taking a risk. What you can read, and you do read this myself, is the ups and downs of the acceleration of debt. When you see it accelerating again, it's time to get into the markets. When it's decelerating, get out. That can give you a guide. But generally speaking, the best thing you can do now is avoid black swans, because there are going to be lots of them out there.
Steve Keen, thanks as always for your insights.
You're welcome.